Ted Oakley, founder of Oxbow Advisors, returns to the show on Kitco News. And on the agenda today is a Federal Reserve meeting next week and Ted's views on the markets for 2023, specifically which sectors will do better, worse, and what will happen to inflation and the rest of the stock market. Ted, welcome back to the show.
Thanks, David.
You have several funds with different strategies, and we'll talk about these different strategies and how your views pertain to these strategies. But first, let's talk about the Federal Reserve. They're meeting next week, their December meeting on the 13th and 14th. Now, I want to just bring up Federal Reserve Chairman Powell's speech at the Brookings Institution in Washington, D.C. recently, where he said that he expects a slower pace of rate hikes to follow.
After our November meeting, we noted that we anticipated that ongoing rate increases will be appropriate in order to attain a policy stance that is sufficiently restrictive to move inflation down to 2% over time. Monetary policy affects the economy and inflation with uncertain lags, and the full effects of our rapid tightening so far are yet to be felt. Thus, it makes sense to moderate the pace of our rate increases as we approach the level of restraint that will be sufficient to bring inflation down.
It's widely telegraphed after the speech that the Fed will raise rates by 50 basis points in December. Is this something that you expect to happen? Is this sufficient? Is it under tightening? Is it over tightening? What's your view?
Well, you know, David, it doesn't surprise me that he sort of telegraphed that because, number one, if you remember, they're pulling 95 billion a month out of the system, which is really tightening in its own. I mean, you don't have to tighten the rates to make that money more tighter. And so that keeps increasing. Nobody's talking about it, but it increases every month. The other thing, I'm wondering if he's trying to keep it settled down a bit, because if you look at the TGA, the Treasury General Account, they've got a lot to do between now and year end in terms of money. And so I'm thinking that he probably doesn't want any spike, at least going into that. Now, I may be totally wrong on that, but my guess is there's a little bit more than just what he thinks is going on in inflation right now.
He is also looking at the labor market. You know, the labor market so far, according to the unemployment rate, which is backwards looking data, is not terrible, although new layoffs are getting announced pretty much almost every day. Just today, I'm reading the news from CNBC. Morgan Stanley cut about 2% of staff on Tuesday, sources say. Morgan Stanley cut about 2% of its global staff on Tuesday, according to people with knowledge. The layoffs, that's just one company. There's many other companies I can draw examples from. So certainly the labor market is experiencing some troubles, to phrase lightly. People are worried. People are worried for their job security. People are worried about the economy. What's your view on what's going to happen next year? Is this going to get worse or better?
Well, I think the general unemployment will certainly go higher. Now, it starts now with white collar. If you look generally right now, there's more white collar really than the rank and file employment. What I do think will happen is the entire thing will go up, in the first half of the year, so that unemployment will go from where it is now to a higher level. I think it's fooled a lot of people that we haven't gotten that yet, but that's still to come. You're really not into the hard part of the recession yet. So when you get there, they lay people off. And so we'll see what happens.
A structural problem in the labor force that Jerome Powell highlighted in a speech at the Brookings Institution is that there are fewer and fewer younger people entering the workforce. Indeed, the labor force participation rate has been dropping. Now, do you see a structural long-term problem in the labor force in America?
Well, the demographics certainly aren't in the favor of that. The other thing you have to, if you break it down sometimes, David, and look at jobs where people have to stand, like service jobs where they have to stand and wait on people and that sort of thing, that's where they're having a lot of trouble right now. Now, I don't think a lot of young people want to do that necessarily. I think that's one of the things, and maybe they don't pay them enough to do it. But when you break it all down, there's some demographic structure you're going to have problems with in filling that through, and we'll just see how it plays out. But I'm feeling as though that unemployment rate goes higher.
Okay. Now, how much higher is the question? Right now, we're currently at 3%. I've heard as high as 6%, which is double. Typically, towards the beginning of a recession, unemployment is low, and then it spikes up during a recession. We've had close to double digits the last time this happened. What do you think is going to happen this time?
Well, if you're around 3.6 or 3.7 right now, you could easily go to, 5.5, 6. I mean, it just depends on sort of how weak things get, but I would certainly look for 5 to 6. I would assume maybe you go higher, but you never know until you get into the depth of things and find out how nasty it is, and then you can tell which way, how far you're going to go usually.
Yeah, I do want to talk about the markets now. The markets have, we spoke earlier in the summer, and I know you have a more or less, if I may summarize correctly, more or less a bearish view on the markets overall. We'll talk about your outlook for 2023. Now, since the summertime, we've had a bit of a bottom around September, October. It's come up somewhat, and more recently, in the last week or so, the S&P 500 has softened. But overall, the general trend for the remainder of the summer and indeed the fall season has been up. And a lot of people were hopeful that this might be the start of a renewed recovery. Is that true, Ted? Are we at the start of a renewed recovery in the markets?
Well, David, we've had 3 rallies this year. We had the spring, and then you had one that peaked in August, and then you had this one that started in October. So you've had 3 of those. But here's the thing. We've never had a market low when the Federal Reserve was raising rates into an inverted curve. Now, I'm not saying it couldn't be the first time, but it's a pretty good indicator, and we've never had that happen. So I would be more than surprised if this is a market bottom with what the Fed is doing right now.
How is your fund positioned right now? Have you made any updates since the summer? Are you more defensive still, or are you starting to phase into the cyclicals now?
No, we think it's too early for the cyclicals. I know they've rebounded in here, and I've never seen more desperation at trying to catch a market low and trying to be correct on where the Fed is going and trying to catch the market low. And usually that's not how you make lows in the market at all. But for us, we're not a lot different. We have more than 50% liquid in all 3 strategies. We have a lot of short bonds. We have a few long bonds too. I think you have to start looking at the long bond now because it started fading lower. When I'm saying the long bond, more than 20 years out, because that's where it's going to keep on going lower. So if somebody was looking, you'd start to bite into that a bit. But all in all, we still have a lot of liquidity. When I say liquidity, we don't just hold the cash, but we have a lot of floating rate treasuries, that pay a nice return, 4.20, 4.25. So it hasn't hurt us really this year. So we've stayed with that.
All right, I want to talk about 2 things now, themes and risks for 2023 before we get into your specific sector allocations. The themes for 2023. Now, the biggest theme in 2022, or one of the biggest themes, was inflation. The war in Ukraine was kind of a wild card. Yes, there was a war, supply chain issues, but inflation was the big thing this year. We haven't seen this kind of inflation for 40 years. We haven't seen a dollar this strong relative to other currencies for 20 years. So what's coming up for 2023? What is the big theme of investments for 2023?
David, 2022 ended up being, I know there's inflation, but what it translated into was really financial risk, because, your rates went up, and that was a financial risk. We think when you get into 23, it's going to be recession risk. In other words, companies won't make as much money. You'll have money, you won't be able to borrow as much. A lot of things will be going on, but it will be more of a recession risk as opposed to financial risk. And that's a totally different kind of risk, because it affects companies by just the pricing and how you value them. And that's how we see 23 really.
Okay. Now, in a recession, let's talk about recession investing. Very difficult environment for any investor. Of course, when there's a bull market, everybody's a genius, but the winners really stand out during a recession. How do you stand out, Ted? How does one survive a recession and pull up ahead of the game?
Well, I think people have to remember, David, that the idea of investing just to stay invested all the time doesn't work when you're in a recession. You have to be in a position where you can survive and get to the other side. And I think people have really gotten spoiled since 2009, and they think, well, just, don't worry about it. It's just a short-term thing, comes right back, everything's okay. This is different this time. It's a real true recession, probably. And in that case, what you're going to have to do is, if you don't have liquidity of some kind, you probably are not going to do as well. And we preach this now for the last year and a half, but the main point is that, in investing is that you can't afford to have these 40, 50% drawdowns. And if you get into one of those, it takes so long to come back. So they can say all they want to about market timing, but part of what you want to do is really create a situation where when you get into these recessions and deeper bear markets, you don't get hurt as badly. And the only way you can do that is to have some liquidity.
Okay, there's recession planning, and I do want to come back to that, but I want to talk about how to prevent yourself from buying scam investments. By that I mean companies that are frauding investors or perhaps doing shady business. I'm referring to, of course, the latest scandal with FTX, the crypto exchange that went under for a lot of different reasons. We don't have enough time to get into all of them. And certainly there's been a number of theories as to why they failed. But Ted, I want to just ask you as an investor, what would you look for from a company that is public in your portfolio of investments to warn you, or what red flags would you watch for to warn yourself against buying a company that you think might have similar malpractices? And of course, FTX is not a public company, so it's difficult to scrutinize their financial statements. I'm just going to read a statement from John Ray, the new CEO who formerly oversaw the Enron bankruptcy. He said, "Never in my career have I seen such complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here." Ted, how would you avoid buying a company like FTX?
Well, first of all, we would have never bought that because it's in the crypto area or anything along that line. But because we steered completely clear of crypto, and I think it will go down. Honestly, maybe as one of the biggest. Talking about scams, maybe one of the biggest scams and shams, the whole crypto area that I've ever since I've been in the business, and it was a get rich scheme that really sucked in a lot of young people. It worked for a while, so you sucked in more people, and that's what happened on that. For us, when we're looking at things, we look at things that can produce cash flow. If you can't produce cash flow, we're not interested in you. And one of the things I find about a lot of the public companies too, and if you look, they've allowed these companies to do account. For example, they can do pro forma accounting and adjusted EBITDA. They can do all sorts of things that are not true GAAP accounting. And yet, that nobody looks at it tight enough to realize that, hey, they're not making any money. They don't even make cash flow. And when they have so many companies over the last year and a half that came out that had no business being public, and people bought into them anyway. But just to get back to answer your question, if you don't have cash flow, if we can't determine you've got some cash flow, and then you can't have any growth. Those are all the things we look at. We look at the debt, we debt to total capital. We look at how much money we think they can make in a tough period. And we look at the management as well, but we really look at the numbers. And a lot of people can't do that today. They just buy exchange-traded funds. They have no idea what's in them. And so we're looking at company by company. And if they can't match up to what we want, then we don't own them.
What's more important for you, cash flow or net earnings? Suppose a company has positive cash flows but negative net earnings. Would you still be interested?
Well, the only way that would happen is if you had a tremendous amount of depreciation. So that wouldn't be the kind of company we'd be looking at, because your capital spending would be really, really high. We like growth. Don't get me wrong. We like growth. And if you can grow without taking on tremendous amounts of debt, then that's important. And so that's what we would be looking at, is for companies that would do it. But when I say cash flow, one of my big problems has been with so many companies, and we've let them get away with it. These large corporations, public corporations, is the buyback scheme, and it has helped nobody but management really in most cases. And so that's another thing. That's just one of the other many things that are throwing investors off, because they can't tell the difference between a company that buys back a lot and really rigs the numbers, the one that doesn't. And so that's one of the things you have to look at too.
How do you feel about a company buying other assets as either a form of investment or to add to their treasury stock? Let's take Tesla, for example. At one point, they had a number of holdings in Bitcoin, I believe. That's just one example. A lot of companies have bought assets in other areas to put on their balance sheet for one reason or another.
Well, when it gets away from what I call their own knitting, then we're not in favor of that, because what you want when you buy a company is to know where they are in their business, and can that business increase on its own organically, bring back profit to you, pay you dividends, take the debt down, all the things you want in a company. These companies that decide to go to that direction, if you'll just look at them, look at MSTR and all these companies, what happened is normally most of the time their price got so high that they became bulletproof mentally. And so let's just go buy we can make anything work. We'll try anything. And so in the real world, when that all comes home though, that usually does not work.
Okay. One of the issues that FTX faced, one of the many issues, was that they issued their own in-house token called FTX token, otherwise known as FTT. And that was, in some measurements, a pump and dump. They internally pumped the value of that token up with a lot of measures, including buying up their own tokens using Alameda Research Funds, which is the sister hedge fund associated with FTX. And Sam Bankman-Fried, the CEO, based a big chunk of FTX's overall valuations on this coin that they created themselves. Just from a higher level, Ted, is this a well, it's kind of a dumb question. We know it's not a sustainable business practice. What is wrong with basing a valuation on your own equity or an own asset that's spin off of your own company? In theory, if your company is doing well, that shouldn't be a problem, should it?
Well, I'll try to answer the question, David, but I think the biggest problem with all of these Luna, all of these groups here that had trouble, was they were trying to make something out of nothing. That's very hard to do, because eventually it catches up with you. If there's really nothing under it and you try to make something out of it, yeah, you can fool people for a year or so, maybe a couple of years, but eventually when you get right down to it, there's nothing there. And then it starts imploding on itself. And so all of these people, and I feel sorry for a lot of young people and people that bought into all this stuff, but in the long run, they'll probably figure out that, hey, give me some good real estate, some good stocks, some good private companies. I'll make a lot more money that way.
Now, you said several times in the interview, you like companies with growth, but also sustainable cash flow. And I think that is the biggest question, regardless of whatever sector you're in, besides cryptos. We know that's not something you look at or like, but besides the crypto industry, regardless of whatever industry you're looking at, Ted, how do you determine whether or not a company has sustainable cash flow? In other words, how do you know if you can actually assign a terminal value to this company because it's not going to go belly up the next morning or even next year?
Well, one of the things you do on the common stocks, really, David, is you have to see companies that put on some growth every year without taking on commensurate debt. If you can grow without taking on commensurate debt, then you're obviously going to increase your cash flow to a degree. Maybe not as much as you want, but you're still going to increase the cash flow. The other side you get into is if you get businesses that are the kind of businesses that are what we consider stable, they really are companies that are going to be around a long time, then those businesses are going to produce cash flow. There may be years when they fall off a bit, but generally they're producing cash, and that's how they grow. The same thing. It's the same for us in real estate. Real estate, you like cash flow too. It's another thing. It's what makes real estate so unique, is the cash flow is usually not 100% taxable. But there's many things out there where you can watch the cash flow over time and how the businesses grow enough to give you a little bit more cash flow, a little bit more dividends all the time. And that's where you can want to go with those.
Okay. I want to move back to the markets now. We talked about the themes. Let's talk about the risks now. You said that recession investing is one of the big themes and perhaps simultaneously a big risk. What about the issue of debt, record debt from the government, record debt from the private sector? This is an article from Reuters just released today. Well, the news came out a few days ago, but this particular article is from today. FX swap debt, $80 trillion blind spot, says the BIS. Pension funds and other non-bank financial firms have more than $80 trillion of hidden off-balance sheet dollar debt in FX swaps, the Bank of International Settlements said. Just explain in layman terms for us, Ted, what exactly does it mean to have debt on an off-balance sheet item?
Well, what happens if I'm, if I'm a really large institution or pension fund or something along that line, Wall Street will come to you and they'll set up a situation for you where you have leverage, but they, in their own, what they try to do with that is try to put up, I'm trying to get this real basic, but what they try to do is get you in a position where you won't think that leverage will ever hurt you because of what they do with swaps and what goes on in the marketplace. I've long said, because I own part of a bank too, but one of the things I've found is that in the swap market, we've really not really tested it at any point in time. If we ever have a situation where you really, really test the swap market, then we're going to find out, who's really strong and who's not. But we have so much money tied up in that. Just look at the U.S. though. Total U.S. debt, government and private, 91 trillion. I mean, I started watching these numbers 25 years ago, and they started like 4 or 5 trillion. I mean, it's incredible. Look at the Federal Reserve, 900% change since 2009 on their balance sheet. I mean, we've got debt everywhere, and I'll give you one more piece of debt nobody talks about. And if you get somebody who can give you that number, I'd love to get it. But if you look at securities-based lending, which is what all these big banks do, big investment banks do, to stocks, particularly for people that are in the public companies and they loan against their stocks, okay? There's a tremendous amount of money out there. I just finished an article, at least, that had 2 companies in there, and I believe they were Morgan Stanley and Bank of America. But those 2 alone were up 50%, in the last 4 years or 5 years of their securities-based lending. And it goes to tell you that there's a lot of debt out there that you can't see. That's not in the margin numbers. And so it's the same way with the debt you're talking about on the FTX, the swaps and all that, and derivatives. It's the same way with this. It's all hidden until you get into trouble, and then you'll see who can handle it and who can't.
Yeah. Well, in 2008, one of the triggers for the collapse of the derivatives markets in the financial sector was the collapse of the housing market. Mortgage-backed securities collapsed, and with it, all the collateralized debt tied around MBSs and the derivatives on that, and the derivatives on those derivatives on the CDOs. The whole market came down like a domino effect. Do you see any such scenario happening again this time? Is the market sufficiently over-levered, so to speak, that such a domino collapse could happen again, bringing down the entire financial system?
David, I don't think so on that side right now. I think they learned a good lesson on mortgages at that time. Even though we've had a few companies really dip into the subprime area again, it's not anything like it was at that time. And now what you have to think about is, where would the next trouble be? And I think the trouble would be more on the corporation side, where they have a lot of debt and they are going to have to renew that debt. We have a tremendous amount of debt of low-level companies that really can't afford to have that much debt. And all of that was floating. It rolls over this year, next year, and the next year. Then you're going to really find out who can handle that debt and who can't. Okay.
Well, that leads me to the housing market. We'll talk about that. I'm going to close off on your outlook. The housing market has been in decline. The Federal Reserve Bank of Dallas has actually put out a report where they said that in a bad scenario, the housing market could decline another 20% from current levels. That could bring down a commensurate amount of consumer spending, which in itself is a problem. Now, the housing market is softening, as I said. When you take a look at indicators such as pending home sales, that's down almost 40% on the year in October, which is the most on record in a number of decades, even greater than 2008. That is significant because we don't have a Lehman-style housing crisis yet. We don't have COVID lockdowns. People are free to go out and buy houses. They're just not doing that, right? If you look at a stat like that, what's the first thing that comes to your mind?
Well, you have to remember now, David, that the housing market was in a super bubble just like everything else.
Okay.
Just like stocks, just like crypto, just like NFTs. And the housing market got stupid in its own way. It was good for all of us that have those homes in different places, yeah. But what's happening now is you're getting in a situation where, unfortunately, there won't be any refinance. If you look, most people, have a mortgage that they could never refinance at this level because most of the mortgages are, below 4.5, below 4 probably. So there's no way we'll do any refinancing at this level. That takes one thing out. Second thing out is that you take the mobility completely out of the marketplace because you have a lot of two-earner families where they stretch to buy a lot of house on a low interest rate. Now, all of a sudden, let's say one of those their job gets moved, they've got to move to another city, whatever happens, then think about what they're into now. They've got to get someone to pay a high price for this home, which they probably won't. Then they've got to go buy another home and use that, that 6.75% mortgage. So it all slows everything down now. And I think we had so many people in that industry from all angles. And I look at talk to a lot of builders, and they're really moving inventory right now. They want to get their inventory down because, that they're usually financed at a bank or something like that.
Right.
And I still see a lot of crazy spec homes going up, people that just don't understand what the game is right now. I just saw 2 last week that were over 8 or 9 million. And I'm thinking, I'm not certain what you're thinking about on this spec because it's not going to sell, at least not right now anyway. And, that's going on all over the place. If you look at all the markets, they're the same way. And that's what we're into right now. So it has, in our opinion, at least, it has further to go. And it's a lag, that's a lagging indicator. So it probably will have more pressure on it as you go into 23.
Okay. Well, that leads me to my final question, Ted, is how severe this recession can be. You talked about a coming recession as one of the biggest risks for investors next year. The question is how severe it could be. Now, what's particularly concerning to investors and economists is the fact that never before have we had a recession in which the Federal Reserve is raising rates. So we're actually raising rates into a recession. If you take a look at just 2008, for example, rates were high in 2007, but came down shortly after. Right now, people have to deal with the double whammy of a softening economy, perhaps, a softening labor market, and higher mortgage costs, like you talked about, higher interest costs and service costs on their credit cards if they still have debt and credit cards are piling up. Businesses have to deal with a higher cost of capital. Everything is just going up in price. People have less money to spend because of recession, and they have even more less money to spend because of higher interest rates. I don't think we've ever seen this kind of scenario, have we?
Well, you haven't seen a situation where the Fed kept on raising rates into, a decline. Well, you have seen it, but it's not very often. The problem with it is, now I'm just going out on a limb to think how I've talked to a lot of people in the industry, our industry, about how they're thinking. And I think they all think that, we're going to have a recession, but it's not going to be much. It'll be sort of like the first quarter, of this year, maybe, and we'll pop right back out of it. The Fed will stop and we'll be back in business. Our guess is that you will actually have some nominal negative quarters, maybe one at least, maybe 2, maybe more. And when you get that, that's a true recession because it's not just we had real recessionary numbers, after inflation in first and second quarter, but not nominal. And so when we get into that, I think that's where you're going to see people start to say, gosh, it's slower than I thought it was.
Mm-hmm. And as an investor, going back to my earlier question, how do you protect yourself? What specific sectors do you think will survive this kind of a recession that we're facing? What specific sectors do you think will outperform?
Well, I'll start. We have 3 strategies, so I'll just go each one.
Yes.
But if you look at the stock strategy, we own companies. Now, don't get me wrong, we have about 55% liquid in that portfolio, but the companies we do own are companies that make it through these kinds of times. If you look at it, it's like a MasterCard, a Visa. People use credit cards even when times are bad. If you look at O'Reilly Auto Parts, they do okay even when times are bad. If you look at situations where we have healthcare, United Health, that sort of thing, those kinds of things do better in a recession. They're not your greatest items coming right out of the recession into a new growth period, but you got to think about what can get me to the other side. In the in the income side, we have an high income portfolio. What we look for there are companies that we think can pay above average cash flow. And by above average for us, that's 7, 8, 9%. Okay. That's what we're sort of looking for, because we think even if you have coming off this inflationary level, inflation goes down, those particular types of income, and they're not bonds, by the way. We own, high quality preferreds, convertibles. We own gas pipelines. We own a number of things that really fit that category. And so those things will still produce really great cash flow. Again, in that portfolio, it's currently, it yields probably, close to 3.5 or 3.7, 3.80, but it's half liquid, so the things inside the portfolio are yielding quite well. And then on the conservative fixed income side, I think people have gotten really snake bit this year because they just went into bond funds, and the bond funds themselves are usually long term. They really, most of these people don't know what they own, so that's a problem. We buy single bonds.
Yeah.
But if I were telling people brand new money in that, I say, look, you need to start putting some money out in the long bond, maybe 10%, something like that. But you can do a lot of short paper and do well in it. I'm talking, a 1-year treasury's what, 470, something like that. You got floaters, you got 2 years, munis looking good now on the short end. So there's a lot of places you can put it. But it does look to us that, I can't say for sure, but it looks like potentially that the long bond rate has already peaked, but we'll see.
Interesting. Yeah, I was going to ask you about bonds real quick, because it does seem to me that it is a safer investment given that yields are rising. You're getting a higher APY, more secure return on investment. If you're unsure about the equity markets because of a recession, perhaps fixed income is the place to be.
Well, it is, and I think people, it's amazing how many people are still in the banks and still in like just a money market fund somewhere, and if they'll look at it, it's probably paying them 0.5 point, maybe something like that, maybe less, when they're leaving a lot of money on the table for just short treasuries. I mean, you could do treasuries 0 to 3 or 4 years, and what's my downside? I've got to hold it 2 years. I have to hold it 3 years. Well, anybody can do that. The credit's good. The rate is good. And for the first time in a long, long time, probably over 20 years, David, savings is back. You can actually save money now and make some money on it. And so I think all of those will bode fairly well for short paper, but you need to start looking at some long paper too.
All right, Ted, we always appreciate your candor and your experience and your wisdom. Thank you so much for joining us on Kitco. We'll speak to you again next time.
Thanks, David.
Thank you for watching Kitco News. I'm David Lin. Stay tuned for more. Don't forget to subscribe to our YouTube channel.